So let's start. So we're very happy to be here with this amazing panel. If you haven't watched the previous session, my name is Keiman. I'm a fintech entrepreneur and lawyer, and enthusiastic about the ESG and impact and SDGs. And today I have a very distinguished panel with me of experts from leading organization. So I'm going to let each of the panelists present himself shortly. We'll start with Cecile.
Sure. Hi, everybody. It's really nice to be here this year again. My name is Cecile Blilious. I'm the head of impact and sustainability for Pitango Venture Capital. Pitango is one of Israel's largest and oldest venture capital funds with more than $2.5 billion under management. And more than a year ago, the founders and partners of Pitango decided to start integrating the world of impact and sustainability into the fund. Across the fund, so not through a separate vehicle or a nominated capital, but actually as part of the fund strategy, investment strategy. So I'm working across all funds. We have an early stage growth and healthcare fund. I work with new investments and due diligence processes and with existing portfolio companies in what I call impact migration. And our approach of the impact strategy is what we call the ESG to SDG continuum, and I'll maybe elaborate a little bit more after that. But this is basically my day job.
Okay, fascinating. Galia?
Yes, so I'm Galia Levy. Hello. I work at the Israeli Securities Authority, the ISA, and I'm head of international regulatory cooperation. I'm a lawyer and I'm doing international work for almost 14 years now. I'm leading the international supervising regulatory cooperation in the fields of securities regulation, financial innovation, and others. In terms of fintech and ESG, I'm leading the international work relating to ESG. I'll elaborate a little on it later. And the signing of several fintech cooperation agreements with foreign regulators. We signed this year with Hong Kong, Singapore, lately Dubai and Abu Dhabi we're negotiating. And thank you, that's for now.
Okay, fascinating. Great to say, fellow lawyer on board. Ben?
Yep, so hi everyone, pleasure to be here. My name is Ben Fried, I'm the CEO and founder of Cred. We're a robotic process automation fintech startup working with financial services firms in the wealth management space, both in the US and in Europe as well. One of the tools that we help provide to advisors, to advisory firms, is a portfolio personalization tool, which obviously these days has a large, or ESG and SDG has a large impact on portfolios. We operate on the retail side of the equation, so everything that all of my knowledge and all of my, everything that I'll speak to today will be on the retail side.
Sounds good. And Oded, BlackRock.
Hi, Ziv, and hi, everyone. It's a great pleasure to be here today. My name is Oded Levine from BlackRock Israel. I'm a member of the Analytics and Quantitative Solutions team within the Aladdin business. For those that are less familiar, Aladdin is the investment and risk management technology platform that BlackRock used to manage its entire asset management operation. But in addition, many other institutional investors, asset managers, pension plans, central bank, etc., are clients of ours and use the same Aladdin platform to manage their own book of business. And so when we talk about sustainable finance and ESG integration into the investment process, which is this topic of the panel, for us, that essentially means putting ESG and climate data and analytics at the heart of Aladdin.
Cool. So I want to start with you, Cecile. Just, if you can take us to the world of ESG and SDG. I think there's a lot of confusion between the terms, and I see that you have the ESG and SDG poster behind you. I also have the pin of the SDG. So can you take us and just do a short intro about what is ESG and SDG, and how do you integrate this into your investment process?
Sure. So the world of impacts and impact investing and all around that sustainability is a world that has been evolving dramatically in the past 15 years. You know, the word impact is a bit confusing. I was often asked things like, what is impact to you? What does it mean to you? And I think it's a very strange question, at least to my point of view, because impact investing is really well designed and defined. However, finally, the actual things that are behind the word impact, which are the ESG and the SDGs, are finally converging. And ESG, and I'm really sorry for these acronyms to be so close to each other, and it really is confusing. ESG stands for environment, social, and governance. And this is how we look at companies and what they do internally, basically. So how do they manage their carbon footprint, and what do they do to reduce the usage of natural resources? That means for production companies, things like how do they source their raw materials, how to make sure that there's no modern slavery involved, looking at their supply chain, looking at how they package things, how they manage waste, water, electricity. All these things are critical. For companies that are not doing any material production, mostly in my day job, which is mostly software companies, we look at the carbon footprint and carbon emission of companies. The S part is the social part, where we look at the employees, a very strong component, which is today the diversity and inclusion that everybody's talking about. And finally, this is within the S category, where we look at how companies are managed in terms of their diversity in all their team, their management team, and how they're mitigating risks of things like sexual harassment and things like that, how employees are engaged in profit sharing, training opportunities, etc. And with the G, the governance is where we check the corporate governance of the company. So does it have a board? How many times do they meet? What is the composition of the board, gender, diversity, etc.? What kind of procedures do they have and how do they implement it? And all of that really is internal. It really builds much better companies. Now, when we look at the SDG, that's the external part. The SDGs are the Sustainable Development Goals, which were designed by the UN in 2015 and are supposed to be achieved by 2030. These are 17 goals that are actually hung behind me on my wall, which are really my Bible. And these goals are it's a codification of the world's needs that need to be addressed by 2030, and you can really address them in any way you want. So the beauty of the SDGs is really this codification that aligns everyone to speak the same language and refer to the same targets when they're developing whatever solution they are developing, and it doesn't matter where and what kind of solution it is. The goals are divided into 169 indicators, which are more specific and also have numeric targets in them. And that helps companies look at their product and their business model in the sense of how does my product and business model address one or more of the Sustainable Development Goals. So when we look at the world of impact, we should be looking at both ESG and SDG. And certainly the SDGs are not relevant for all companies. There are some companies that are developing products or solutions that have nothing to do with the SDGs. That's fair, and they still need, we need them, and they need to be funded, and that's all right. But you'd be surprised at how many companies actually do apply and have an implication on the SDGs, and sometimes they don't even know it. Now, this is becoming more common knowledge, and more people are engaging with understanding, identifying, and measuring their SDGs. But this is certainly something that needs to be more known to the public and added on top of the ESG. So that's like the whole map of impact is really ESG and SDG combined. You're on mute, Ziv.
Yeah. So I think what is amazing that NIC is that companies that adopt the SDGs are really exposed to more business opportunities. I've met, for example, Netafim, an Israeli company doing irrigation system. They are aligned with the SDGs, and I met them in various events in the United Nations, and I see that it's really good for business as well to adopt those standards. And I'm going to segue to you, Dad, right now. It seems like ESG is a topic that gets more and more attention. And if we look at the SDGs, which Cecile just mentioned, and we're thinking like, who can move the needle, right? Who can actually change the world in those sense? It is the large institutional investors, and BlackRock is among them and leading them with about $8 trillion under management. So, what's your perspective of this area?
So let me just highlight, because I'm in the Aladdin business, and of course with all the required Chinese walls, I'm actually in a unique position to not only see what BlackRock is doing, but also work on ESG very closely with our institutional clients, which uses the Aladdin platform. And that means many more trillions of dollars under risk management, and you benefit from the collective intelligence, if you will. And I can say there's no single topic that clients are asking us more about than ESG in the impact it has on their portfolios, and especially the E part and climate. And now you can ask, is this trend real, or is this just something that's going to go away? And we strongly believe it's here to stay. I mean, it's very hard to argue with the numbers that demonstrate the actual flows into sustainable investment. Just look at the statistics of, quarter over quarter dramatic rise in inflows towards sustainable funds. That's actual evidence. We just launched the largest ever ETF focusing on LCTR, or low carbon transition readiness. And I'm sure we'll talk about net zero and climate perhaps more on this panel. Now, if you analyze the reasons for what we call this tectonic shift and reallocation of capital towards sustainable investments, these are quite strong and solid reasons, which is why we think this is only just the beginning. And let me just highlight a few of these reasons. Let's start with the company's disclosures. We're seeing much more companies voluntarily disclose ESG-related data. 10 years ago, less than 20% of the S&P 500 firms provided such disclosure. 2 years ago, that number is already up to more than 85%. And for those that are releasing information, it's double the amount of data points. Another point, and this is more and more recognition that sustainable investments do not necessarily represent a trade-off in returns. And in fact, there are different statistics that actually suggest, depending on the time horizon, of course, that investing in the ESG version of some benchmarks actually produce better returns than the parent benchmark. Another key reason is the flow of capital is a threat of climate change. This is becoming more and more prevalent. 2020 will go on record as the worst year when it comes to climate-related damages, $210 billion. And if you look at some of the charts showing frequency of extreme weather events, they also show a steady and scary rise. And lastly, and this is perhaps the most interesting one, there's a huge transformation of wealth happening between baby boomers to Generation X and millennials. Younger people are entering the workforce, they're saving for retirement, and they have money to invest. And I must say, they are much more opinionated than older generations, and that means you and me, Ziv, with regards to where they want to invest their money. Put differently, they don't just care about the value their portfolio generates, but also they want to know about the values of the companies they're invested in. And if that's where the demand is, asset managers, ourselves included, will need to create and provide an ongoing supply of these investment themes. Let me just add a final point here. Consider the intention of investors. BlackRock conducted a survey last year, over 400 investors across asset owners, asset managers, pension plans, 27 countries, representing $25 trillion of investments. And the top conclusion was that investors are planning to double their allocation to ESG investments in the next 5 years. So just to wrap it up, I think this basically means that sustainability is actually going mainstream.
All right, that's great. And perhaps later we can touch about how BlackRock integrates ESG into their investment process. But first, I want to move into regulation and ask you, Galia, can you tell us a bit about what you're doing in this space, what's happening in Israel, and how do you see the regulator role in this space? Should the regulator, for example, enforce disclosure of ESG standards? Please take it.
Okay, so thank you, Ziv. So like Oded mentioned, in recent years, we see developments in the leading capital markets around the world and growing interest of investors in corporate responsibility. Now, the Israel Securities Authority in its agenda, in our strategic plan, we call for the market development and opening the Israeli capital market to the international arena. So naturally, the ESG disclosure is one of the tools that the ESA is committed to push forward in order to serve the interests of investors. So for several years, we examined at the ISA the need to adapt rules on the disclosure of ESG aspects by a reporting corporation whose securities are traded on the Tel Aviv Stock Exchange. This is our mandate. So we see our role is to guide the market, to set the professional framework, and provide the tools for initiating ESG reporting. So we're formulating an initial ESG outline, published it for public comments, received many. By the way, we conducted 2 roundtables, both with local and foreign market players, and to discuss the outline with market participants. And after reviewing all the data that we heard and received, we came up with an outline of voluntary disclosure of corporate responsibility and ESG risk factors, which was published, by the way, a few days ago on Sunday. So what does it say, our outline? Now, the ISA calls on all reporting corporations whose securities are traded on the TASI. TASI is the Tel Aviv Stock Exchange, to publish an annual corporate responsibility report. This is a call for a voluntary disclosure. We call on the corporation who choose to do so to carry out the publication on the basis of accepted international standards, such as the GRI or the SASB models, to publish the report on their company's website. And if they would like, a copy can be published on the designated website of the ISA, and with proximity to the date of the publication of the annual report. The report can be published in English in order to serve the interest of the companies in appealing to international investors. And we intend to support the reporting company through professional training and workshops. Now, our outline is basically based on what happens in the world. Maybe I will elaborate it a little bit later. But I'll just say that in some markets, the ESG disclosure trend started from investors, like the US market, as Oded mentioned, and the regulator now adjusts to this. And in some markets, we're already seeing advanced regulations, like in Europe. But maybe I'll talk about it later.
Yeah, I think it is really interesting to see whether a regulator will move into enforcing these disclosures, because it is in the essence of what every investor would like to know. Moving on to you, Ben, the issue of data and technology challenge with integrating the SDGs and ESG standards. This is a real challenge. I know that when I go to Yahoo to invest, I can see some ESG data. Can you tell us what stands behind it and what the challenges that you are facing with your company and the solution that you provide?
Yeah, absolutely. Like Oded mentioned earlier, the adoption for definitely for younger generations, but I would say it's not exclusively there. It's really widespread. There is a pretty high demand for involvement in the portfolio construction and understanding where my capital is allocated, et cetera. And when you're dealing with retail clients or retail investors that are looking for exposure to certain industries or request to not to be in certain places as well, if I don't divest from oil and gas or whatever the case may be, you do need to make sure that you're balancing a few things. One is, are you giving the correct data about their exposures? And that relies on data sources, on third-party data sets that you have to mix and match. And so there's a pretty big effort right now in the industry, I think, from a lot of different players to generate that type of data. Some of it's coming from regulators. Some of it's coming because companies understand that disclosing will actually help them grow. It will allow folks to invest in their companies. The challenge is really around how do you aggregate all these different data sets? How do you make them speak to each other? And then how do you deliver that to clients in such a way where they can understand, or to investors, so they can understand their real exposure, what they're really doing with their assets. And you do have, on the retail side, you do also have to mix in the, it's not just building one big portfolio. We're building essentially personalized model portfolios for each investor. And there you do have to account for what they're going through, their worldview, et cetera. And so there's an interface topic there where you have to help them understand what is going into the portfolio, despite the lack, in many cases, of financial knowledge on their end. It's not quite as easy as saying, I want exposure to green, or I want exposure to diverse companies, or whatever the case may be. You have to go a little bit deeper, but explain it in such a way where it's easily consumed on their side, and at the same time keeping the balance of the portfolio so that you're not skewing yourself too far in one direction or another in terms of the risk. So there are quite a few factors that go in here. You have to build the correct models to enable the delivery of those portfolios to retail clients, and make sure that they're understanding what they're getting. They have input within a framework that makes sense for them, both in terms of the exposure that they're looking for on the ESG level, and in terms of the exposure that they're getting on a risk level. So there are a few different factors here, and really what we're looking forward to, especially with firms like BlackRock, obviously, but you have a lot of fintechs that are doing this as well, is really getting more and more granular on the data sets that we're being fed, so that we can trust those data sets, we can rely on them. There are no gaps in the data, which remove companies from the equation or reduce your universe. So there are a few factors that go into this, but it's definitely accelerating, and we're seeing more and more companies come to the table with richer data sets. So that's very, very helpful.
Interesting. So I'm going to move now to a third part of an open discussion, but I want each of you to try and bring his own view about the subject. And the subject is climate risk as investment risk. So I remember I was in a presentation in New York by one of the big accounting offices, and they showed a presentation looking at climate risk as a systemic risk, a risk that touches every point of the business. How much are investors taking this into consideration in their investment? Are they looking about who's more exposed to climate risk than others? Are they looking about will invest in this business because it actually reduces the climate risk and climate effect? What's your thought on the subject?
Who do you want to start? I think we all have something to say about it.
Yeah, this is an open discussion, so Oded, you can start, and then
please feel free to chime in. Well, I think it's becoming more in the mainstream to think that climate risk is investment risk. Maybe 2 years ago it was an aha moment, but now I think it's more of a mainstream concept. Now, our conviction on this is pretty straightforward. In order to achieve better risk-adjusted returns, investors need to take into account the full set of risk and opportunities facing a company, and that includes climate-related risk. And we believe the risks, and therefore the opportunities, of course, associated with climate change, both physical risk and transition risk, are just not priced in appropriately. And let me say something very sound extremely obvious, but risk management is not just about risk elimination. We all know that every investment decision we make has risk inherited in it. The first question is, are we even aware that we are exposed to such risk? Are we able to measure the magnitude of the risk? Only then we can make an informed decision on how we want to manage that risk. Do we want to divest, meaning sell out completely? Do we want to hedge it? Or it could be that we are aware of the risk, we understand it fully, and we're fine with it. But that's a much stronger position to be in. And when we talk about climate risk, we typically talk in terms of physical risk, so the direct damage and financial loss due to things like heat waves, hurricanes, sea level rise, wildfire, etc. And so if I'm invested in a portfolio of, say, properties or municipal bonds, or if I underwrite a mortgage or an insurance policy, I need to know where that asset is located physically and find a way to quantify such risk and take into account the exposures to these type of weather events in terms of asset pricing. So how much am I expected to gain or lose in a particular climate scenario? The other type of risk is transition risk. And this is really the risk arising to companies as the world is moving towards a low carbon economy. It could be driven by new regulation or just because people's behavior and preferences are changing. And it has an impact on the products people buy and how much they're willing to pay for a specific service. So, for example, if there's a rapid shift in government policies, say a new carbon tax, which security do you want to have in your portfolio, Exxon or BP? If, for example, 2/3 of car demand is now moving towards electric vehicles, how would Toyota compare to Ford? Having tools to analyze these type of questions provide investors with an advantage. Let me pause there because I can go on and on.
Yeah, I just want to say, like, you look at the numbers and it seems like we're boiling like frogs. So I would expect that, you know, we would have more than just data analytic, but just like a very strong statement saying that, you know, we should move to zero carbon, and in actuality we see that that's happening. What's your thoughts, Cecile, Ben, Galia?
I can talk. It's Galia. If I talk about regulation, if we take the UK as an example, in the UK since 2013, companies are required to attach non-financial information to their financial statements. But in the last year, the UK has done major progress in terms of ESG, and specifically related to climate reporting. In November, the UK announced its intention to make the disclosure requirement recommended by the TCFD, which I will explain in a minute, mandatory until 2025, when a significant part of the requirements will apply until 2023. Now, the TCFD is an international task force on climate-related financial disclosure. The TCFD recommended a voluntary disclosure outline on the financial effects and risk management aspect related to climate change. But the UK, however, intends to make it a mandatory disclosure, and they issued a roadmap to implement this. And this is the first country to take a comprehensive mandatory approach regarding climate disclosure. And this corresponds with the global trend of setting the issue of climate in a very high priority. That's a trend that would be progressed in the few years.
Let me chime in the angle of the venture capital investor and tech startups, and here so 2 levels. First thing I wanted to say is that you're probably aware of an initiative by Sir Ronald Cohen and Professor George Seraphim at Harvard Business School that is working on impact-weighted accounts, trying to attribute to traded companies also the externalities and the cost, so the actual impact, and factor that into the price of the shares. That's something they've been working on, and they're actually showing how different companies in the same domain have a totally different negative impact, actually, that should be factored in. I'm really encouraging everyone to look at this. It's really quite interesting. I hope it's going to take on and be used as you know, mandatory, same way that we do financial accounts, so that people will not only look at risk returns, but actually risk return and impact. And now the angle of the technology. So for us, this is an opportunity. And just to give you an example, we have in our portfolio a company called Tomorrow.io, used to be called Climascale.co, and what the company does is it takes weather conditions everywhere on the level of from in 5 minutes to all the way to next week, and provides insights that are related to specific industries. So if we take, for example, the ship that was stuck in the Suez Canal, that's a really good example, and they actually wrote an article on that, on how their software could have actually given this insight to the managers and of the Suez Canal, as well as the captain of the ship, and tell him that the winds that are going to be in the area when the ship crosses the canal are likely to move the ship and get it stuck. So that would have saved, I don't know how much was it, $50 billion a day for 2 weeks or something. So so the fact that we can do something about it, and not necessarily about climate, because that's not really applicable right now, but about weather and weather insights, and how we help companies take better decisions, which make better business outcomes, which save lives. Those are things that are the bread and butter of startup companies, because there's a problem which is very well defined. There can be a solution that these startups think of. There's a business model behind it because it creates real value for their customers, which is translated into dollars. So all together, we see companies that really have embedded into their business the risk of climate change and the weather consequences of it as part of their business. So I think, to us, this is a real opportunity.
Okay, I think I also saw that there's accounting standards that try to take into account the triple bottom lines. There's one by McElroy, and I think that's also very interesting. Ben, you want to say some last words for this panel?
Yeah, I mean, I just think that, listening to everyone speak here, whether it's from the institutional risk side or from the venture capital side or whatever it is, we look at it very much in terms of exposures. And no matter, when you look at a obviously we operate in retail, but when you look at an investor, what's the gap really is today is in lots of folks not understanding what their exposure really looks like. And so when you look at, obviously you'll have a lot of retail investment managers that'll build a model portfolio. They'll use, asset classes and whatever they're using to build their models. But those asset class allocations are very much a high level, broad way of building without understanding the granular details underneath, that are underlying the actual assets that are owned. And so whether that's what Oded was talking about in terms of, look, what's your actual exposure to climate change, or whether if you're looking at a client with VC exposure, or even an institution with VC exposure, you're saying, well, what does that VC exposure actually look like? Those are things that are pretty difficult to measure today, just because the data doesn't necessarily exist. And so when we look at all of these asset classes, we're essentially thinking, what is how do you build more visibility into the actual underlying exposures? And then how do you go and risk manage that and balance that across the board? So very fascinating to hear all of these different perspectives from very different asset classes, very different parts of the market. But at the end of the day, it goes back, for us at least, to how do you measure it, how do you identify it, and then how do you take action on what's out there. So absolutely fascinating.
Thank you. Today, I should mention this is Earth Day. So we're mentioning that every day is an Earth Day. We don't need just to mention it today. And I think we have in this panel all the different elements that can actually make change. There's the large institutional investors, the big money. There's the regulator who can enforce those standards. There's the technology companies, and of course the VCs that take the risk and invest in those companies. So a very interesting and great composition of a panel. And I want to thank every one of you who've joined us today for this panel. And we could have, I guess, more panels one after another and discuss this subject, which is so elaborate and so important. So thank you.
Thank you very much.
Thank you.
Thanks for having us.
Thank you.
Thank you.